This is a great question. I agree with you. The past 10 months have been very difficult to be an investor in bonds, the supposed safe haven of all portfolios. We have seen record repeated rate hikes by the Federal Reserve to attempt to reduce inflation in this economy, and the effect has been a higher yield on bonds, which drives down the price of bonds. I say this because of the past 10 years as a bond investor, most, if not all of the return of your bond portfolio was due to price appreciation and not the coupon payments that the bonds provide. Bond prices should not be the primary driver of the total return of bonds. With short-term yields approaching 4% and the 10-year U.S. Treasury consistently hovering at or over 4%, coupon payments of bonds will now be that driver of return for the foreseeable future. There is also the opportunity for price appreciation of the bonds as the Federal Reserve begins to back off their rate hikes once they see some positive data on inflation reversing in the United States. So as an investor, I get a yield on my bond portfolio that is higher than it's been in the past 10 years and the opportunity to invest at lows not seen in even a longer period to capitalize on this price appreciation of the bonds. These opportunities don't happen very often, and they offer very exciting possibilities. One thing I've learned in my time analyzing investments is not to time the market. I'm a big proponent of staying invested for the long term versus being a trader on short-term news. The Federal Reserve could continue to raise rates for the next couple of years because inflation will just not come down to meet these targets. While this would continue to decrease the prices of bonds, yields will continue to rise and investors will be rewarded with higher coupon payments from their bond investments. Bonds are in investors' portfolios to provide diversification from equities and to provide income. Investors will continue to be rewarded with higher income than they have seen in over 10 years. The overall positive effect may take a little longer to come to fruition, but investors will be rewarded for their patience in this bond market. It's true that the inversion of the yield curve has caused many investors to pull money out of longer duration fixed income products and put those funds into money market funds, short-term bond funds, CDs, and other instruments that provide higher yields in shorter time frames. This has proven to be a smart decision for 2022 and could remain in place for the beginning of 2023. It's important to be diversified within the bond space, both across credit and duration. What does this mean? We believe that over the long term, clients are rewarded for owning different parts of the yield curve, along with different types of bonds like treasuries, asset-backed securities, corporate bonds, municipal bonds, things like that. All of these help provide this diversification. Right now, in this environment, the shorter-term bonds have been very helpful in the portfolios by limiting losses and providing some yield. This speaks to the most fundamental part of any investment process: buying low and selling high. In this case, selling high means selling things that have not gone down as far as everything else. It's an opportunity to rebalance the portfolio by reducing the overweight percentage in these portfolios with these short-term bonds and buying into longer-term bonds that are down some over 15% so far in 2022. There's no reason to make it any more complicated than this. Sell what's worked and buy things that we think provide a great opportunity at this point in time.